What's up everyone? So in this video I'll talk about two recent trades I made, one on the short side and the other on the long side of the market. I think that these trades highlight different strategies and market conditions, giving insights into both bullish and bearish setups. So let's jump right in and analyze these trades together. So taking a look at the 1 minute chart, you can see how straightforward it is to sort of identify the market's bias, and then once you've got that figured out, it leads you towards an area of interest and subsequently an entry point. And let me explain here what I mean. Starting from the bottom here, we have got this clear sideways action happening that results in a nice 40-point rally. After that spike up, we consolidate for a bit before the market breaks out. At this point, you are probably thinking, okay, we have got this steady and strong continuation to the upside here. On top of that, bull sweepers have been relentless in buying up everything in sight. So why not just, jump in long here? I mean, it sounds logical, doesn't it? Well, hold on a moment here. This upward movement is deceiving, giving a false sense of the market's true direction. The reason behind this is what's known as a smart money trap, where Wall Street's big players cleverly distribute their holdings at inflated prices during what appears to be a breakout. This maneuver traps unsuspecting buyers who basically jumping at the top while also shaking out weaker hands holding short positions. It's a tactic to grab liquidity from these positions right before the real downturn begins. Now the question is, how do we determine when the downside is likely to start? Well, and as I mentioned earlier, it starts with our 1 minute chart, which is quite clear in showing the market's direction. Simply draw a Wyckoff's market cycle phases on the chart, starting with the accumulation phase, moving into the markup phase that eventually leads to the distribution phase. And now, after printing above the 5220 level, the market confirmed to us the peak of this distribution phase seen from the occurrence of this upthrust after distribution pattern, which, when read correctly, signals a shift from bullish to bearish momentum. Furthermore, following this series of lower highs here, there was an attempt during this sideways move to retest the highs, which failed, leading to a break in market formation that reinforces the idea that the top of the distribution phase is in place. So this is our ranges cap right here. Another thing I like to point out is that this sideways period signifies, in my view, a pause within the broader downtrend. Also, guys, keep in mind that when the market fails to establish a new high and instead breaks below critical support levels, such as the 52-15 area here, it often indicates a shift in momentum from bullish to bearish. At the same time, as the price tries to stage a modest bounce off this level here, attempting to alleviate some of the bearish conditions but failing, it confirms that this support level has now turned into resistance. This flip zone further supports my bearish bias, which is why I placed my short at this level. And as you can see from the price action, the entry played out nicely. However, my mistake was not closing the trade once price started printing higher lows down here. That hesitation actually cost me about 500 bucks. So in hindsight, I didn't maximize my risk-reward ratio with this trade. Despite that though, it was still a solid win, so can't complain here. Alright, let's now transition to the second trade and go over some of the technical factors that influenced this entry. Now, after the price takes a 100-point nosedive in a 30-minute chart, we see some interesting price action happening that initially results in a sideways movement forming a support level. This sets the stage for the creation of a liquidity grabbing area or a stop hunt zone. And now this stop hunt zone here marks the bottom of this trading range, which is important as an area to keep an eye on. And the reason for that is because it's where institutional players hunt for liquidity from retail traders before starting a trend reversal. It's important to remember here, guys, that stop hunting is usually exercised by smart money near uptrend highs or, in this case, downtrend lows. It's a move where price basically dips below key support levels, triggering a sell-off. However, what typically follows as a result of such a manipulative stop-loss grabbing move is a recovery wave that pushes the price back above the range's support. So after this 40-some point rebalancing move down here, the market reverses higher with this higher low, showing strength as the price works on an uptrend breakout direction with a base now off of the 80s level. Additionally, the price not only crosses above the 9-period exponential moving average or EMA, but continues to trade higher and above it, signaling sustained upward momentum. Now, it's worth noting that the ability to establish support above a key moving average like the 9 EMA is often viewed as a bullish signal, as it suggests that demand is strong enough to overcome short-term pullbacks or profit-taking. Also, this 30-minute pullback, though small in appearance, holds significance in my opinion because this period of barcoding signaled to me that the market was undergoing what I refer to as a reassessment of its price delivery process, or RMPDP. Essentially, this is a sign that the market is trying to determine its next directional move. And so as the price moves up above the EMA while maintaining, and again, this is important to remember, while maintaining its support, it breaks through the 52.23 breakout level, which, and as shown in the chart, coincides with my entry point. Now, if you're new to trading, when a key level like the 23 level gets taken out, it can really kick things into high gear on the upside. See, all those traders who were shorting or taking profits at this particular level are now forced to cover their positions by buying back in. Now, that extra buying pressure from the short covering just adds more fuel to the rally. The reason why we call this a breakout move is because, if legit, it can really get the ball rolling in the breakout direction, especially if you see volume starting to spike as well. The idea is more players catch on to the breakout and jump on board, accelerating the move. At the same time, though, you gotta be careful not to blindly buy into every freaking breakout you see out there. Most of the times, they can be fake outs, especially when the market is really choppy and volatile. That's why you should always look for confluence of technical signals lining up behind the breakout move, at least that's what I do, before pulling the trigger. Back to the chart, as the market now continued pushing through the upper level of the trading range, I opted to add another contract, a decision that obviously set the stage for more green. And speaking of breakouts, if you guys are interested in deeper dive into my breakout strategies, make sure to watch this video next. Alright guys, as always, thanks for watching, and I'll catch you all in the next one.